Good afternoon, everybody. Welcome to our webinar on exploring careers in sales and trading. We're Quantitative Analyst. I'm Heather from Champ America, and today we have the honor to invite Tony Zhang, the Chief Strategist for Options Play. Before we start, let me give you a quick intro on Tony. Tony right now leads the research and development of Options Play's ideas and portfolio platform. He has leveraged his interest in the financial technology and product development area to provide innovative solutions to clients and users that they seek to serve. Tony is a specialist in the financial services industry with over a decade of experience in product development, research, market strategy roles across equities, foreign exchange, and derivatives. Prior to Options Play, he spent 7 years at Forest.com with capital markets and research background as a market strategist specializing in equity and FX derivatives market. So, Tony, welcome.
Thank you.
Now, you kind of segue into the question that we were going to ask first. That a lot of people here are students, and the number one question they often ask is, to get into this field, what's the kind of background that people generally need in order to get into this field?
With respect to backgrounds, generally speaking, most people from this field come from some type of economics, finance, business type degrees. We do see some, math and physics backgrounds, but really, the crux of what we really need here is people who have a basic working knowledge of the financial markets. Mm-hmm. That is really the basic fundamentals that you need in order to enter the quantitative and research type roles is a working knowledge of how the financial markets work, because no matter how advanced your quantitative skill set is, if you don't know how to apply it specifically to this industry, right, it's really, there's limited work that you can do, or you need a lot of help in order to get into this field. So that's really where, if your background is in math and finance, my advice to you is make sure you have a better understanding of how capital markets work. Some of the best ways to do that is actually just to do some trading yourself. Right. Buy some stocks, buy some bonds, buy some options, even if you just risk small amounts, or even if you just do it in a practice account or a virtual account where you're not risking real money. That really helps you better understand how you can apply your quantitative skill set to this specific market.
Right. And I see you on the deck that you have a point that says understand how things are connected. So I'm assuming the broader economic news that impact the equity market and bond market, and what's the correlation, things like that? Exactly.
So the one thing that you'll learn as you do more trading in this specific, in finance, is that all things are sort of in one way or another interconnected, mm-hmm, right? So when we talk about stock trading or bond trading or fixed income or currencies, these are all things at the end of the day that are intercorrelated. And understanding, the more correlations you understand across more asset classes, the more useful you become as a quant. Because as a quant, your role is to basically find trading signals or find ideas. And where do you get the data to get these ideas? A lot of times that data comes from other markets, mm-hmm, markets that are correlated but may not be directly influencing markets. So the more of these intermarket analysis that you understand, the better sometimes your models can be built. So, for example, going back to some of my early days of modeling in FX, we were trying to model currency exchange rates, where they should be 1 month forward. And we had to look at all different types of asset classes in order to build these models, because currency rates are influenced by interest rates, by commodity prices, and understanding these fundamental connections between different markets was the difference between making a good model and making a bad model. So really understanding how different markets are connected is one of the skill sets that a quant really needs to do in order to truly break into this field.
Gotcha. So now when students attend recruiting sessions, whether it's on campus or apply online, the one sexy title, if you will, is always sales and trading. And people flock to those positions thinking, that's one of the coolest jobs on the street. So what's your view on sales and trading? What do they really do?
Yeah, so when we talk about sales and trading, or before we talk about sales and trading, I think what I want to do is just bring up a little bit of an understanding of this industry, the finance industry. And I want to break this down between buy side versus sell side, because that's going to help us determine kind of what a sales trader actually does. So the finance world is really broken down into sell side and buy side. And you can think of sell side as the firms that are their main role is to basically execute and clear trades for their clients. And these types of firms, the way to define them is that they generate their revenue from commissions and fees for executing trades. An example of this is firms like Goldman Sachs, TD Ameritrade, Bank of America, Morgan Stanley, Credit Suisse. These types of firms, they basically execute trades on behalf of their client. And they generate their revenue from the commissions and fees that they collect from helping their clients execute these trades. And the roles for these types of firms is what we consider sales and flow traders. And this is the group that's actually client facing. This is the group that actually talks to the end client and tells them or faces the client and accepts the order, and also at the same time provides ideas to generate orders. And what backs up these sales and flow traders is what we consider the research and quant analysts at these sell-side firms that produce the reports and the ideas and the trades that the sales and flow traders then disseminate to their clients, and hopefully comes back with some actual trades.
Right.
Along with that, you always have compliance and legal work that comes along with that. But the crux of what generates revenue for these firms is the sales and flows traders that talks to the clients, and the research and quant analysts that sit in the background that generate the ideas that the sales and flow traders actually go out their clients with. So these two groups are the primary revenue drivers of a sell-side firm. Conversely, on the other side, you have buy-side firms. These are firms that manage assets. These are firms that manage mutual funds, ETFs, pension funds, hedge funds. They generate their revenue from managing assets. So they get a percentage of the assets that they manage, or what we consider assets under management. An example of these types of firms are ETF providers like BlackRock and Vanguard, hedge funds like AQR, private equity funds. These are all fall under what we consider the buy-side fund, meaning they manage institutional assets and they collect a fee for managing those assets. So for these types of firms, on the buy-side firm, what we generally have is you have proprietary traders that basically their role is to execute the trades of the strategies that these firms have. You have portfolio managers and research and quant analysts that really do the crux of the work of deciding what do we actually buy with the assets that we have. So for example, a hedge fund may have $1 billion under management. What do they actually buy with that $1 billion? That's what a portfolio manager will actually institute the strategy, and the research and quant analysts help them provide them with the data to decide exactly what do I buy with this $1 billion. Do I buy stocks? Do I buy bonds? Do I buy Apple? Do I buy treasuries? Whatever that is, that's what these proprietary traders, portfolio managers, and research and quant analysts will come up with. And then you always obviously still have compliance and legal on the buy side that really helps support in the operations of these types of roles. So you can think of yourself, if you're going to your brokerage firm and you're saying, I want to buy 100 shares of Apple, you can consider yourself as a small buy side because you are executing a trade. You are deciding what you want to buy. So you would fall under that buy side, and the firm that's helping you actually acquire that 100 shares. So if you go to TD Ameritrade or E-Trade or Fidelity or Schwab, that's the sell side firm, because their role is to get you that 100 shares, and they're going to collect that $10 commission for helping you execute that trade. So that's the best way to think about buy side and sell side. Each firm has their roles. And when we talk about sales and traders, they are quite different from these two groups because one is actually acquiring the assets and one is helping you acquire those assets.
Right. It's probably worth to point out to students that on the sales side, at some point, traders were taking proprietary positions, probably more so, right? And with the regulatory environment, this is becoming far less than what it used to be.
Exactly. So the way sell-side firms used to operate is that if I wanted to buy 100 shares of, or let's not use stocks for example. Let's talk about currencies. Let's say I as a buy-side firm wanted to buy €1,000,000. The firm on the other side that's helping me acquire that €1,000,000 would effectively sell me that 100 million euros or that €1,000,000. So what that means is that we're effectively on the opposite side of the trade. Because I'm buying euros, I want euros to go higher, and the firm that just sold it to me is short euros, then they want it to go lower. So the firm that's helping me execute the trade has some risk there. Traditionally, there's two ways to do this. You can either keep that risk on your books and hope that euro goes lower as a firm, and firms made a lot of money doing this, trading the other side of their clients' trades. But as regulatory environments have changed since the financial crisis, firms now on the sell side do not generally hold on to this risk anymore. They will generally offset that risk or hedge that risk as soon as they execute that trade for their client, so that they're fairly neutral at the end of the day for the positions that they hold. So sell side firms used to take proprietary positions. They used to trade on the other side of their clients for the most part, which was a big conflict of interest for a lot of these sell side firms. But that kind of has been stemmed quite a bit since the financial crisis.
Got it. So that leads to our next question. On the buy side and on the sell side, who are the quantitative analysts? Because a lot of us here are interested in becoming one. Mm-hmm. And in recent years, we also have an increased number of students who major in data science. Mm-hmm. And they're also wondering, since quant sounds like people that deal with a lot of numbers, mm-hmm. a lot of data, can we become a quantitative analyst on Wall Street?
Right. So in order to look at what a quant does, I think before we look at buy side and sell side, I think the overall goal of any quant or data scientist within finance is really to generate alpha. And when we talk about generate alpha, we mean making money, but more importantly, not just making money, but making profits that are above a benchmark or some kind of baseline, if you will. Now, how a quant helps a client generate alpha is going to differ depending on whether you work at a sell-side firm or a buy-side firm. So at a sell-side firm, a firm whose role is simply to help clients execute trade, a sell-side quant is really designed to create ideas and trades for the sales and trading team to be able to sell to their clients. An example of this is a quant research team decides that right now is a really good time to buy US equities. That is a research tip that the quant team has developed, that the sales and trading team will now go out to all their clients and say, now is a good time to buy US equities. And if their clients end up buying US equities as a result of that research, the sell side firm makes more money or makes their commissions and fees. So the goal of a sell side quant is to generate more ideas or unique ideas for their end clients that really help differentiate that sell-side firm from other sell-side firms. So for example, if you work for Morgan Stanley, and Morgan Stanley says today you should buy US equities versus Goldman Sachs is saying you should buy European equities. Mm-hmm. So these two firms have differing views as to what you should buy, and the quant teams usually, or the research teams, help provide this. Whether it's a quantitative model or not is a different story, but it's the research team that helps decide what you should trade. And the quantitative team really helps support that research. And that's really where the quant's role is within that research team, is to provide new ideas, fresh ideas. And the great thing about quantitative analysis is that you can look at quantitative analysis instantaneously across millions of metrics, versus a research analyst traditionally is looking at only a limited number of things, because a human can only analyze so many things at once, versus a computer or quantitative strategy can look at millions of things at once. And that's really kind of where the role of quants have really expanded on the sell side, because they're able to generate infinite number of ideas. As long as they have proof or research behind their ideas, they can generate a lot more ideas than a traditional research analyst can. And that's really kind of why we're seeing more of an explosion of growth on the sell side as far as what a quantitative role on the sell side. On the buy side, a quantitative role is simply to generate, specifically generating alpha. And this is where it's not just generating ideas, it's really generating better returns than the benchmark. Because on the buy side, every single buy side firm, whether you're managing an ETF or a mutual fund or a hedge fund, is benchmarked against something. And the role of that buy side firm is to beat that benchmark. So if you're not able to beat your benchmark, you are basically not worthy, if you will, of managing those assets, or you're going to get less assets to manage if you're not able to beat your benchmarks. So a role on the quantitative side, on the buy side, is really how do you generate the most return for the money that you have to manage. And you only have a finite amount of money to manage. So for example, if your hedge fund manages $100 million, you have to figure out a way to make the most amount of money from that $100 million, more so than any of your other competitors, and at least beat your benchmark. So this is really where the quantitative role is to support the research team in deciding what do we buy with this $100 million that gives us the highest possible return, or the return that, or the return profile that the client is asking for. So if the client wants exposure to treasuries, then you have to figure out how do I allocate my money across treasuries that gives this client the highest returns within the treasury asset class. So that's really where the skill set of a quant analyst, regardless of whether you're talking about the sell side or the buy side, is really an understanding of capital markets, meaning how do I generate ideas and how do I generate trading strategies for whether it's for a client on the sell side or it's for our own firm on the buy side that generates alpha. That is the crux of what a quant does for both of these firms. And in order to do that, you not only need to understand an idea, but you also have to understand how to actually generate profits from an idea. And that's something we'll cover in that next slide.
Okay. Traditionally, when people think about quants, they're thinking of that physicists, people with an engineering background, or with the applied mathematics background, usually PhDs. And is that still the case?
I think that's you're absolutely right. Traditionally, we think of quants as really, really smart guys that come from very sometimes esoteric backgrounds like mathematics, applied mathematics, physics, these types of backgrounds. But I think what we've really seen over the last few years is that these types of very esoteric fields, while important in pushing the boundaries and really pushing the boundaries, it has not really resulted in some of the results that they claim to be able to do. Well, we generally find that there's generally more bang for your buck, if you will, if you hire quants that have that may not have as high degree understanding of mathematics or physics, but much better understanding of how they can apply their knowledge to the capital markets. That is far more important than how advanced you are within a certain field of mathematics or physics than someone who's less knowledgeable about that stuff, but way more knowledgeable on how to apply that to the capital markets. And that's something I think is really important, and we'll discuss that in the next slide as to why that's so important.
Okay, sounds good. Will you be talking about a trading model with us in today's session?
Yeah, so I think the best way to understand this is actually just break down an actual trading model or a model that a quant, either on the sell side or buy side, would look at, and that helps kind of also frame your last question. So when we talk about a trading model, this is really the combination of what we consider a signal and a trade. Because in order to generate real ideas that your sell side clients can actually act on, or as a buy side firm to be able to manage assets with, you can't just provide just a signal or a trade, you have to provide both. And these two go hand in hand together, and they can't be created in isolation, they have to be created together. So this is really where the role of a quantitative researcher will differ depending on how much knowledge you have about the capital markets. Because like I said, in order to generate true usefulness for your firm, both on the sell side and buy side, you have to really be able to put the two together. Meaning, think of it almost like an architect of putting all the different pieces together. An architect may have helpers to help them build different individual pieces, but you still need someone at the end of the day to put it together. And that's really the culmination of a true quant's work. Now, in order to understand that, let's break it down into signal and trade and what the difference between the two is, and how to put it together, and why they need to be considered together and not separately. So when we talk about a signal or an idea, this is really using various metrics in the markets technical, fundamental, statistical factors, whatever data that you can grab your hands on, using that data to determine the direction of that an asset will move in. So whether you're talking about stocks, bonds, futures, forex, commodities, whatever it is, having an idea of where you think something's going to go. And the work here really is just taking an idea, back testing it, and then optimizing your idea until you get the best possible signal. And an example of this, of a signal or an idea, is that we think that treasury yields will move higher in 3 months. That's an example of a signal or an idea. And this can be backed up by fundamental, statistical, technical research, whatever it is that a quant will use to figure out that idea. That is the work that a quant will have to do, or research will have to do, to figure out what factors am I looking at to generate the idea that I think treasury yields will move higher over the next 3 months. Now,
so you just mentioned that quant might also use fundamental research rather than just statistical or numbers, right?
Correct. Okay. Meaning anything that's data in theory can be looked at by a quant. It doesn't have to be technical or statistical. It could be fundamental. It could be, we've even seen models that use the position of stars. It really doesn't matter what you use your data, as long as you can prove that your data generates returns or generates whatever goal that you're trying to generate. It doesn't matter what type of data you look at, right? And the more esoteric the data you look at, or more alternative the data you look at, generally speaking, potentially the better the signals. Because if you're looking at the same data everyone else is looking at, right, chances are you're not going to be able to generate true alpha. So a lot of times the quant's work is finding alternative data sets to generate these types of signals. So, but the end goal of the signal is to say, I think something will go to a certain point in some time in the future. That's the goal of an idea or a signal. However, a signal in itself is useless, because if I can't profit from that signal, or if I can't trade that signal, it really doesn't mean anything other than
it's an idea.
Other than it's an academic paper for all intents and purposes. In order for you to actually generate alpha, you need to be able to execute a trade and profit from that trade, and that requires understanding the mechanics of the capital markets, right? So for example, how do you actually structure an actual trade that will profit from the idea? That is also potentially falls under the work of a quant, but really a quant that understands the fundamentals of trading, understands the fundamentals of how capital markets work. So for example, if the idea that we have is that 10-year treasury yields will move higher over the next 3 months, how do you actually trade that? And there's multiple ways to do this. You can short the treasury futures that will profit if interest rates rise. You can buy a treasury put option. You can buy interest rate sensitive stocks. There are infinite number of ways of structuring this type of idea. So it's one thing to take an idea. It's another thing to it's one thing to generate the idea. It's another thing to figure out how do you actually maximize the profit for the amount of capital that you are willing to risk. Because you only have a finite amount of capital. You have to figure out what's the best way to allocate that capital and generate the most return for potentially the smallest amount of risk. And that also is the work of a quant. Now, in order to put all of this together, that's really where a true, what I would consider quant comes into play. Otherwise, you're basically doing the work of an architect that is really putting this together, and you may be helping optimize the signal, meaning you're helping do a lot of work to look at different factors to figure out what factors give me the cleanest signals, or the best probability signals, or the signals of the highest return. And then another quant may do the work on what is the optimal trade to make to maximize my profit for the amount of capital that I have. And this really comes into play of understanding capital markets, because shorting treasury futures may have certain limitations that you may not that you may have limitations of shorting treasury futures in terms of how much capital you can apply to that, or how much margin is required to place that trade, versus buying a put option has a completely different trade structure and a completely different risk tolerance. So there's understanding of how these all come together is really what I consider the true work of a quant. And you have to account for things like transaction costs and liquidity of the markets that sometimes when you're in school, or if you're looking at a project, you may not consider these types of things like liquidity and transaction costs, but these are all real world things that have to be considered. And this is really what I'm talking about in terms of real world experience of capital markets. And even if you do trading on a virtual account, more importantly, if you do trade some real accounts, that's really where you gain that type of knowledge. And there's really no shortcut to gaining that knowledge.
Right. And then just when I was working in the banking world, the profitability of each group, right? You might have a number on paper for your group, but centrally we also allocate your capital costs and liquidity charges and a number of other charges, right? So you, as you said, you really have to take all these other factors into consideration.
Correct. Yeah. Right. And that really only comes from actual experience of working on either a sell side or buy side firm, understanding, and the trading part is the piece that's most difficult to really understand how it works, because you have to actually have placed trades or seen trades placed and see how they react to the markets, the different conditions in the markets. It's one thing to understand how trades work in a normal functioning market, but understanding how trades function during the financial crisis is a whole nother thing, right? So meaning going through different business cycles, understanding what it's like in a bull market, what it's like during a bear market, what it's like during when liquidity is plentiful and when liquidity is not there. These are all things that quants have to consider when they're structuring their trade. And the only way to really do that is from experience, in my opinion.
Gotcha.
So just last point, in terms of, I think you want to talk about the difference between a quant and a data scientist. In my opinion, a quant is really someone who ultimately helps put these two things together, right? Because everything from the idea generation piece to figuring out what is the most efficient way to deploy your capital to profit from that idea is the work of a quant. However, a data scientist, someone who has a data scientist degree, who may not have that capital markets understanding, may not understand how to profit from that particular trade, can still have a lot of functions within these roles in helping the optimization of the signals, in helping the optimization of the trading strategy, because the work of that really is involving taking vast amounts of data, running multiple thousands, if not millions of simulations through that data in order to optimize or find the best possible scenario. And that's really the work that a data scientist does in many other fields, right? So this is really just applying that same theory to finance. The only thing I would say that just even a basic working knowledge of the capital markets really helps you stand out as a data scientist within this type of role.
So eventually, as you catch up on your capital markets knowledge, and that data scientist or someone with data scientist background could eventually get on the track of a quantitative analyst as well.
Absolutely. In my opinion, the work that a quantitative analyst does at most sell-side firms and most buy-side firms is not advanced at all from a quantitative side or from a math perspective. It's really more so the people who advance in this quantitative role is not necessarily advanced in mathematics, but more so advanced in their understanding of the capital markets.
What about programming? Just out of curiosity.
So the question was, what about programming? And I think the programming is almost at this point a prerequisite for most of these roles. You can certainly get away without programming. However, I think you're going to be very limited compared to the candidates that have basic programming. And when we talk about programming in these roles, especially when we're talking about the quantitative side, where you're not actually touching the actual trading mechanisms, a lot of it can be done in Python. So you don't necessarily have to have object-oriented C++, C++, C#, Java. A lot of the work that you can do can be done through Python, Visual Basic, MATLAB, R. These types of languages are many times more useful for the quantitative roles.
Great.
So just for an example of looking at a real model, this is something that we're working on here at Options Play, just to give you a feel for what it feels like to be a research analyst in this particular role. And this is for more so on the sell side, but it can be applied to both sell side or buy side. So what we're currently looking at for a signal is we're looking at a combination of technical and statistical factors to determine stock directional moves. And we're specifically looking for what technical and statistical factors can we generate stock directional moves over a relatively short period of time, about 3 to 5 weeks out. We're basically optimizing for is what factors can give us signals that gives us the highest probability of a stock moving either higher or lower over a relatively short period of time. And the result of this work that we've done, and this came out of thousands and thousands and thousands of backtests that we had to run was optimize signals that generate the highest probability of success for 4-week returns on all S&P 500 stocks. So what we wanted to optimize for was what would give us the highest 4-week returns with the highest probabilities on all S&P 500 stocks for a certain period of time. And this really came, what you do is you start with an idea. You say, when these technical factors look like this, buy the stock and see what the returns are, see what the probabilities are. And then you take that idea and you tweak it. You take the technical factors, you change the thresholds that when you generate the signals, you change the thresholds of how you calculate those technical signals. And there's an infinite number of ways of doing this. There's no right or wrong way. It's all about getting to the end result of a signal with the probability and return profile that you're happy with. So that is, an example of the work of a quant will do to optimize a trading signal. So once we've generated this algorithm that determined signals using technical statistical factors that gave us probability and returns that we were happy with, the question then became, how do we actually profit from that? And there was a lot of different ways that you can do this. You can buy the stock when you thought that the stock was going to go higher. You can short the stock when you think it was going to go lower. You can trade options. You can buy call options. You can buy put options. You can sell options. We ended up determining that the best possible deployment of our capital with these signals was to sell 5-week put credit spreads. Now, I'm not going to get into what that actually means because that requires a bit of an understanding of the options. However, we looked at the profile of our signals and we realized that we didn't have really good returns, but we got really, really good probabilities. And we had to understand what is the best way to actually profit from that. And that required working knowledge of the option markets and understanding the different strategies and saying what strategies will take advantage of high probability signals that doesn't necessarily have very strong returns. And understanding that put credit spreads or call credit spreads was one way to profit from that. So that really required a true understanding of actually trading in the markets, understanding the transaction costs, understanding liquidity factors to determine this was the best optimal strategy in order to profit from this. And this required testing lots of combinations of strategies, different expiration dates, different strike prices, different strategies in order to get to this. So this is what it looks like to put together a true end-to-end trading strategy, is coming up with the idea, testing that idea, finding the best possible risk profile for those signals, and then more importantly, how do you actually profit from that and be able to show the backtest that profit from this, not only over a short period of time, but over an extended period of time, and going through all the you could say mistakes that you can make using backtesting, making sure that you've covered all of those possible mistakes and generating the best possible return at the end of the day.
Okay, so in terms of the specific skills, right, what were the things involved in building this model?
So the specific skills boils down to, number one, understanding how markets react to technical and fundamental signals. This is some of the stuff that traditionally you learn in school. Basic technical analysis, basic fundamental analysis, knowing things, knowing what things move the markets, and really taking that So taking those skill sets, applying them, taking a theory, applying them, testing that theory, and then continuously optimizing, continuously changing your theory until you get the best possible performance out of it, right? So that, in my opinion, is not rocket science. That just requires, number one, a basic understanding of financial markets, and then constant reading or constant trading to search for new ideas and new methodologies, if you will. But for the most part, most signal generations follow a few major methodologies, if you will. I wouldn't say that there's a lot of advancements in that particular field. We all generally generate our signals off of a few different methodologies. The question is just what factors do you look at within those methodologies that change substantially from one firm to another.
Factors, you mean?
Like, for example, I might use RSI as my technical factor, and I might use a 14-period RSI, but someone might use a 15-period RSI or a 16-period RSI. And there's an infinite number of factors that you can look at from that perspective. But for example, how we determine which stocks are best, which stocks are worst, is following a ranking methodology. And that is a very popular methodology and has been proven to work. The question is, how do you rank your stocks will differ from shop to shop, but the concept of ranking stocks against each other is a very, very common methodology to determine which stocks should we look at, which stocks are most bullish, which stocks are most bearish. That is a very common methodology. The question is just how do you actually determine bullish and bearish will differ from firm to firm.
Right. So all these models, right, essentially, they are built upon similar foundations.
Correct.
But they're built upon different or variations of assumptions, if you will.
Correct.
And those are things as a firm, as a team that you guys would discuss, agree on, and put that into that model methodology.
Yeah, and a lot of quant work is trial and error. It's coming up with an idea, testing it, and seeing how it works. And if it works well enough, you then work on optimizing that to try to get better results.
Numbers speak, right?
Exactly. So it's really about throwing a bunch of things against the wall, see what sticks, and whatever sticks, you try to focus on those and optimizing.
All right. So now, any advice for those thinking of going to sales and trading or the quantitative field, right? And we talked a lot about how the industry has sort of changed, especially since the financial crisis, right?
Yeah.
Buy side, sell side. And I've read about or heard people saying if you want to go into sales, right, you need to be the ideas generating person. For trading, it's going to be, you need to be almost on a solutions desk, right? So do you hear such comments, or what's your view on that?
Yeah, so the industry certainly has changed a little bit since the financial crisis, but I actually think it's shifting in a way that's beneficial for quants because firms have been really figuring out ways to cut costs, and one of the biggest teams in these sell-side firms is research. And the reason that research teams are so large is because, for the most part, the largest group is actually equity research. So teams that are paid to come up with ideas for individual stocks. That is by far the biggest group or the most costly group to a lot of these firms. And the reason because these groups are so large is because we have 8,000 stocks in the US equity markets, and each analyst can only cover a handful of them, if not a single one. A quantitative analyst, on the other hand, can potentially look at all 8,000 stocks at the same time. And this is really where the cost measures of the quantitative side helps, because the quantitative analyst can look at a lot of different, not only a single asset class, they can look at the entire asset class at once. And that's really, in my opinion, compelling for a firm to hire a few analysts that can cover all the stocks, as opposed to hiring thousands of analysts to cover a small portion of the stocks. So the industry is certainly changing, in my opinion, in favor for the quants. However, this idea that quants will just be able to replace fundamental research or humans is also something that we've seen change a lot over the last few years. There was this idea that, hey, we're just going to hire a few quants and they're going to be able to turn around everything and magically make profits, and that generally has not happened. So there is a lot of uphill battle in justifying the role of a quant. In showing that quants can generate alpha has been a struggle. But I think,
why do you think that's the case then?
And I think the reason for it is because a lot of quants don't have a true understanding of both pieces of the signal generation and how to actually profit from it and putting it all together. Quants typically help optimize each piece, but putting it all together has traditionally has not been the strong suit of quants. And I really think that that's really where this industry needs to shift. Not necessarily quants that really understand high levels of mathematics, but more importantly, quants that understand how financial markets work and how to apply basic understanding of quantitative strategies to the financial markets is more relevant than taking very esoteric strategies and trying to generate more alpha, in my opinion.
Interesting. And let's talk a little bit about fintech companies like your own.
Yeah, so fintech companies is really kind of the new player in this game. It's something that's really we've seen over the last just 5 years or so, because we always think of finance as buy side and sell side. And those are really the only two roles. But fintech is really starting to carve a new piece of this market. And it's certainly taking a chunk out of buy side. So we look at firms like Betterment and Wealthfront. These are firms that are basically taking that buy side model and saying that, hey, we can replace, and this is really kind of what we're talking about, is replacing fundamental analysts that take a lot of cost, and saying that, hey, we can replace that with a computer model that can do the same thing that a human would do at a fraction of the cost, right? So a lot of the buy side disruption that we're currently seeing is in the ETF space, in the mutual fund space, in financial advisors that cost 1% of your assets under management, versus the computer can do it for a fraction of that. Mm-hmm. So we're seeing a lot of disruption on the fintech space. So a lot of the quant research stuff in helping you manage your assets is really a new role that didn't exist a decade ago. Also, there's a lot of fintech now where they don't necessarily sit on either buy side or sell side. They kind of straddle the two. Firms like Options Play ourselves is an example of that, where we service both sides. We help sell side firms generate more ideas for their buy side clients, and we help the buy side clients generate ideas that end up generating transactions for the sell side. So we really help straddle both sides, and we have a value proposition to both sides, and firms that are able to produce research that generates alpha can really take that and pitch it to both sides and not just one or the other.
And I like your strategy of straddle.
Mm-hmm. Yeah.
Pun intended.
Yeah.
Great. So I know you guys have been hiring people, interns as well, right?
Mm-hmm.
So those are typically quantitative interns, right?
Yep. Mm-hmm.
And what do you typically look for?
So as I've said many, many times in this webinar, is the most important thing that I look for is not necessarily how advanced you are in quantitative fields or how advanced you are in mathematics or physics or programming, but way more important is how well do you know the capital markets? Meaning, if you come up with an idea, do I know that you understand the fundamental reason of why we are taking this type of strategy to profit from this signal? Because if you don't understand those two components together, then you're really only limited in what you're able to help me with. You're only able to help me with the optimization of signals, or you're able to help me with the optimization of the ideas. You're not able to help me really put the two together, and that's really what we're looking for. So it really boils down to an understanding of the capital markets. And like I said, there's no shortcut to that. And the best way to get started is start trading on a virtual trading account where you're not risking any real capital. Hopefully you do that enough times where you feel confident enough to start risking some small amounts of capital, because there is that difference between trading a real account and a fake account that really elevates transaction costs and liquidity factors that can't be considered when you're trading just a virtual account. But a virtual account is a very good stepping stone. But understanding how capital markets work, how to actually profit from that, and putting the idea and the trade together is by far the most important factor that we look at when we're hiring interns and analysts.
Very cool. Now, last question. If you could go back in time and doing what you do now, is there anything you would have done differently?
I would have learned how to code in Python. I would be able to do, I think of myself as more of the architect role, right? I don't have a very strong quantitative background. I have a very good understanding of the general methodologies that quants will deploy. I have a good understanding of analyzing the results of a quant. I may not know how to do all the work of a quant, but I certainly know the end result of what they produce very, very well. And that's actually another skill set that I think is very important in this role that doesn't exist for a lot of quants. So being able to do some of that work myself, I think would be satisfying from my perspective. But yeah, so I think learning programming would certainly be one thing that I would change about that.
So for most guys, they're lucky in that in the current curriculum for many of them, coding in Python is almost a requirement.
Yep. Mm-hmm.
So you guys are lucky for that.
Yep.
With that, I think we're going to hand it over to the audience and see if there is any questions. Early on, there's a little bit about shakiness and voice, which we fix subsequently. Any question from anybody? While we're waiting for questions, I guess what I heard from Tony today, great presentation, and what I heard over and over is no matter what you plan to do, sales or trading or quant, having a basic level of capital market knowledge that's crucial, right? Almost necessary. And to do that, definitely follow the market and start out with a little buy and sell on your own from virtual accounts to small amount of capital to really understand how certain other factors, cost, plays a role in real trading. Secondly, I think you explained very well today in that understanding the role between buy side and sell side will really help you differentiate the roles and responsibilities for sales and trading world, right? You really have to understand where they belong to where they sit in order to really understand what their end goal is.
Right. I actually think another good starting point and how I learned a lot of this stuff was actually reading the research reports from the sell-side firms. That is a very, very good place to start because you really get to see everything from the idea generation to the trade that the research analyst is suggesting based off of that signal. More importantly, how do they convey that message to the end client, right? Because it's one thing to build the signal, it's another thing to build the trade, it's another thing to be able to convince the client to actually execute that trade. So that three-pronged approach is really when we talk about sales and trading and research. The three have to work in conjunction with each other in order for all of this to work. So the end result of all of this is that research report. So many of you go to school, you guys have access to Bloomberg, you have access to the research databases, you have access to the sell-side firms' research. For free. And this is money. This is the type of research reports that buy-side firm pay thousands and thousands and thousands of dollars for these types of reports. You guys have access to it for free. Just reading that is a very good start in understanding the true work of what a quant and a research team puts together. Understanding because not only do they have to generate the end result, they have to convey why or how they got to the end result. So really, and that really gives you a lot of insight into what that quant research team is actually working on, what factors they're looking at, and more importantly, what the end result is. And I think that's a really good place to start for a lot of people who are interested in getting into that quant.
Right. And a couple of the points that I took down, the industry environment has changed a little bit in favor of the quantitative research side, because the sort of coverage it can reach at the level of cost.
Yeah.
And also being a data scientist, guys, you definitely have an opportunity to get into the quantitative field. Initially, you understand the tools. Initially, you might be more involved in helping the quants, optimizing the strategy. But as you gain more knowledge of the capital markets, how the signals and trade, how these two pieces come together, you are eventually going to be able to take on the role of a quantitative analyst. With that, I think I see a question. Thanks for your presentation. Which is more difficult to get in, buy side or sell side? Eternal question, right?
Definitely buy side is always going to be harder to get into, and that's simply because buy side just simply has less positions available. Buy side firms traditionally are never large firms. No matter how large the buy side firm, even if they manage trillions of assets, they're still doing it with, generally speaking, much less headcount than sell side. Sell side is generally speaking a little easier to get into, and buy side will typically hire from the sell side. So usually you start out, get your experience in sell side, generate ideas for your clients, and if you generate enough good ideas or ideas that seem unique enough, that typically opens up the opportunity of moving over to buy side, because the buy side clients are really the clients that see your sell side research and read your research. So the more research you're able to put out, the more publicity you're able to get on the sell side, the more likely you are going to be able to move over to that buy side.
And it's interesting to also point out that the sell side is actually more regulated than the buy side.
Correct. So buy side, because it's your own assets, you're deciding what you want to buy with it, you can do whatever you want, right? On the sell side, because you are generating your revenue comes from commissions and fees, there's obviously a somewhat of a conflict of interest, because what if you're telling clients to buy something just to generate more commissions and fees, when in reality that isn't necessarily good for the client? And that was a big problem that I think we had in the 80s and 90s. You know, sales and traders were just putting out whatever research that would generate the highest commissions for them, and ended up screwing over their clients. This is a very short-term way of thinking. because you were just trying to generate the most amount of transactions, get a huge bonus. And a lot of these guys would move shops every time, regulators caught up to them. So now that obviously has changed a lot. Regulations has come down substantially on the type of research that a firm puts out, and that the research must be must follow certain laws and regulations regarding conflict of interest with their clients. So nowadays, in my opinion, that's better, because now it really comes down to the quality of your research, not necessarily, not necessarily kind of how much revenue your research generates for the firm. So I think that that's actually a plus for quants these days.
Absolutely. All right. So if there's no further questions, and Tony, we'd like to thank you very much for your time.
Thank you.
It was really helpful. Guys online, and for those of you who are going to catch up later on and review the webinar on your own, if you have any questions, please contact us. We're at info@champamerica.com. And if you're interested in applying for an internship at Options Play, you're more than welcome to send your resume to us as well. All right. Thank you very much.
Thank you, Heather.